Hey financial warriors, welcome to the show. And yes, it is official. The Fed just hiked interest rates, the largest hike that they have done in 28 years, okay, since 1994, 0.75 of 1%. And this comes after the S&P 500 crossed into bear market territory on Monday, dropping 21% from its recent high. And if you don't know, a bear market is when the stock market drops 20% or more. You can contrast that with a correction, which is when stocks drop 10% or more, with obviously the bear market being the more serious of the two. And we've seen a slight bounce after Monday, but not really much. The market is basically trading flat. Slight move to the downside immediately after the Fed meeting today, although most of that downside was probably priced in already. And guys, in this video, we are going to look at all the factors so far that are indicating that we are heading to a recession, or that we probably already are in a recession, in fact, and what to expect, how long it might take, what you should be doing with your money, and how you can actually make money during a recession. But first, when the market is down, it's kind of like stocks are on sale. So it is a great time to cautiously start getting into buying up some of those cheap stocks. And to do that, you obviously need a brokerage account. And right now, you can get 6 free stocks for signing up and opening a new account and depositing any amount of money with the brokerage app Webull. These stocks together could be worth up to $12,600. Luck of the draw, what you get. Webull is a commission-free stock trading app. You can buy stocks, you can open an IRA, you can also buy cryptos on there as well. So link is below if you're interested. Now, this drop in the market and hike in interest rates by the Fed comes alongside a host of other indicators that do indicate that we are heading into a recession. So first of all, obviously, is inflation, which is why they are hiking interest rates to deal with inflation. And inflation right now is running at 8.6%, which is the highest since 1981. But in reality, the actual figure of inflation that people feel in their budgets may be a lot higher than that. And that is because they have changed the way they work out inflation, okay? Back in the 80s, they were using quite a different method, and I did do a video on that if you guys want to check that out, what the real inflation rate probably is. I'll give you a clue, it's probably close to double what the government is claiming right now. Now, inflation is a leading indicator of a recession. Generally, recessions are preceded by inflation, and the inflation this time has been caused, of course, by the flood of free money that permeated the economy throughout the coronavirus pandemic. We then have the very sudden and dramatic crypto crash, with the total market cap of cryptocurrencies now under $1 trillion. To give you a contrast, it was about $3 trillion just 6 months ago. Now, crypto is a highly speculative, volatile investment, and I think people used to think of it as a hedge against inflation, kind of like gold, but oh no, not anymore. Since crypto has gone mainstream, it basically moves pretty much in sync with stocks, just in a more volatile way. So the S&P 500 is down 20%, Bitcoin is down 70%. And the metaverse, don't even get me started on the metaverse. Wasn't 2022 going to be the year that metaverse coins exploded? I'm looking at my holdings in the Sandbox. I mean, that was like close to $7 a few months ago, or half a year ago or something. It's now less than $1. But it makes sense that crypto is one of the first things to drop, because when people have limited amounts of money to invest, they can obviously look for the best quality, most stable investments, not sort of YOLO moonshots, all right? Like putting your money in coins with pictures of cute dogs on them. The Dogecoin Millionaire, you may have heard his story. He's basically lost pretty much all of his investment now. He bought into Dogecoin at around 4.5 cents a coin with around $200 last year, early 2021. He rode it all the way up to $3 million, and he's rode it all the way back down now, and Dogecoin is now at 5.3 cents per coin at the time of recording. So he's basically almost lost his entire investment. He's gained a lot of social media followers along the way, so perhaps he's gained in other valuable ways. But it's not just these big high-profile cases. People are running out of money left, right, and center. The savings rate is at its lowest level since the 2008 recession, just 4.4%. In other words, the average person is only able to save 4.4% of their monthly paycheck. And credit card balances are climbing and could go a lot higher. And with the Fed hiking interest rates, interest across the board is going to go up. So on those credit card balances, interest rates will go up. Mortgage rates will also go up. and that's going to reduce demand for buying houses and for new construction. Just look at the price of lumber, which was at all-time highs because of the Canadian trucker protests earlier this year. A lot of lumber comes from Canada. Well, it's now crashed, losing over 50% of its value. Basically, there is soon going to be a lot less demand for products, which should bring inflation under control. Okay, demand destruction, you reduce demand and thus prices have to come down to entice people to buy things. But it's probably going to lead to a lot of job losses as well. If companies aren't selling as many products, they don't need as many staff to make or sell those products, so there will be layoffs. Now, the crypto industry has been the first sector where we have seen this, with Coinbase, for example, cutting their workforce by 18%. Someone who was laid off from Coinbase actually even commented on our channel yesterday. But job losses are not normally a leading indicator of a recession. Mass layoffs only tend to start to happen once you have already been in a recession for some time. In the 2008 crash, although it started in 2008, unemployment did not peak until late 2009. And we may already be in a recession right now, since we've already had 1 quarter of negative GDP growth, with GDP down 1.4% in the first quarter of 2022, and a possible second quarter of negative GDP. And if that happens, that is one of the strongest indicators that we are in fact in a recession. 2 consecutive quarters of negative GDP figures. So large-scale layoffs are a very real possibility in the coming months. I think the Fed even increased their expectations for the unemployment rate and lowered their GDP expectations in their meeting today. It will start in the more speculative industries. Think of places where people don't really need to spend money. That's where they'll cut back first, probably like the crypto industry. Tesla also recently laid off 10% of its salaried workforce. And I believe it will only get worse from here. So how long will it last? Well, the average bear market lasts 359 days. The quick flash crash we had during the coronavirus pandemic lasted just 33 days. However, that was an unusually quick recovery, probably due to the fact that we pumped trillions of dollars into the economy in the form of stimulus, and also the fact that it might have been a little bit of an overreaction at the beginning and the market didn't actually have to go down that much. So that was an unusual case, but if you have a look at this chart of bear markets over the years, you can see that some of them, like in the year 2000, the tech bubble, last as long as 900 days. That's almost 3 years. So I personally think we have moved back into more normal market conditions where bear markets can last several hundred days. This isn't like back in March 2020 where I was putting out videos saying, I'm buying stocks right now, or this is the market bottom, okay? March 23rd. I was right about that, by the way. But right now, I'm not doing that. I have a lot of cash sitting on the sidelines, and I'm basically waiting to start dollar cost averaging in. I don't think we're going to see a bottom until later this year, maybe even into early 2023. But I probably will dollar cost average my way in starting this summer and going into the fall. One optimistic thing is, though, that we do have the midterms coming up later this year, and if the Republicans manage to take over the House and the Senate, which I think they probably will, that could signal the start of getting the economy under control. Here's a quote from Jeremy Siegel, professor of finance at the Wharton School of University of Pennsylvania. The most favorable outcome for markets would be a Republican win in both the House and the Senate. If Republicans take the House and not the Senate, that would also be a relatively favorable outcome. In general, whenever a conservative government takes over, and these statistics go for the US and the UK, the stock market will generally rise and the economy does better. And that's because they generally will lower taxes and deregulate industry. And I know they're probably looking to deregulate the fossil fuel industry, which is going to help gas prices. And of course, lower gas prices will help every single industry, because almost every single industry relies on energy. Now, obviously, the presidential election would have a bigger impact, but the Republicans taking over the House and the Senate would probably be a good start at getting things under control, economically speaking. But you know, if you listen to the president, he says that there's no recession and everything is doing great.
We have the fastest growing economy in the world. The world.
So I don't know, guys, maybe just stick with Biden and pretend that the economy is doing well. But anyway, guys, I'm guessing we will see a bottom after the midterms, or maybe around the time of the midterms. And then from the market bottom, it usually takes an average of around 38 months to reach the next all-time high. So don't let the recent flash crash during the coronavirus pandemic trick you into thinking that you have to plow all your life savings into the market right now to catch the market before it bottoms, okay? You do not need to do that. You can dollar cost average in, and actually from where we are right now, we may be going down another 15 to 20%. Now for myself, as of now, I have not bought anything. In fact, I bought $100 worth of a certain stock this morning. But other than that, I have not bought anything. I will be looking for opportunities to dollar cost average in, probably start buying the dips as we go lower. If we do. If we don't go lower, I'll buy on the way up. And I'll most probably be looking for some dividend stocks in addition to beaten down growth stocks, just so that I have a little bit of an insurance that I will be able to make some money even if the market is flat for quite some time. And then I will also be taking advantage of the low lumber prices to build the investment property that I've been going on about for like 2 years, but I've been basically waiting for lumber to come down over the past 6 months or so, and it is finally at an acceptable level for me, so we should be starting to build that relatively soon. Guys, let me know what you think about all this. Leave your comments below. What are you doing? Are you buying stocks? Have you got cash on the side? Do you think we're going lower? I'd love to hear what you think. Don't forget to get your 6 free stocks from Webull. Link is in the description below. It's a great deal, guys. Not sure how long it's sticking around for. Anyway, please subscribe to the channel if you're new, and we'll see you next time. Bye-bye.